Hello guys, and welcome to this class on how to identify uptrends or downtrends according to technical analysis. Basically, I have 3 points here. These 3 things have to be true for the price to be in an uptrend, for example, and then I will say the same for the downtrend. It's basically the same but inverse. So first of all, the moving averages have to be in sequence. What does it mean that the moving averages have to be in sequence? It means for an uptrend to be true and valid according to technical analysis, the moving averages have to be in sequence. The smallest time frame for the moving average has to be above, and the longer the time frame in the moving averages will be below. So in this case, we have the 20 above and then the 50 below. If we had here the 100 and the 200, they would be in sequence as well. The 100 would come after and then the 200 at the bottom. The second rule is that the price has to be above moving averages, any moving averages, so for it to be a valid uptrend. So for example, here this is a very clear uptrend because we have the moving averages in sequence and the price is above moving averages and just bouncing on moving averages and always staying above them. And the third rule is price action. For an uptrend, the price action needs to be going up. Price action equals highs and lows. So price action going up means higher highs and higher lows, and price action down means lower highs and lower lows. So in the case of the uptrend, the 3 rules is moving averages in sequence, the smallest moving average at the top and the bigger moving average at the bottom, the price above moving averages, and the price doing higher highs and higher lows. So these 3 rules and these 3 conditions are true from when? Since the moving averages cross and they become in the right sequence, right? Because before here it was the wrong sequence. The blue was below the red, which means the longer time frame for moving average is above. So this is not an uptrend sequence. So it became a clear uptrend from here, this cross, until when? Until the next cross. This was an uptrend until the moment of the moving averages crossing bearish, and right at this moment, the price action changed automatically from up to down. So we started doing lower highs and lower lows. So this was a clear uptrend, and this is a clear downtrend. Why? Because we have the rules, again, being valid. The moving averages are in sequence but inverse. Now the smallest moving average is at the top and the bigger one is at the bottom, so they are in sequence but the other way around. The price is below moving averages. As we can see, it didn't go above moving averages since it came below them, and the price action is doing lower highs and lower lows. So from this point on, since the moving averages became in a bearish sequence up until today, this is a clear downtrend for swing trading the daily chart using the moving average strategy. So basically, you need to remember these 3 rules to identify an uptrend or a downtrend. If these rules are mixed, if you have one of each, or you want, the price is not above or below, for example, here I'll show you a very clear example. When these rules are not true and you have, the price is above and below and in between them, and then below and above, but this part of here, this is there's no defined trend. There is not an uptrend, this is not an uptrend, this is not a downtrend, all this part here, right? Prices in between moving averages and going above and below. Moving averages are not really in sequence because here they cross for one sequence and then right after they cross again. So there's no trend defined, there's no rule, we're not following any clear rule here. So these are the parts of the market where you want to avoid at all costs. You don't want to trade these parts of the market. You should be waiting in the sidelines for the trend to become clear, and then you re-enter the market again. That's all for this class, guys. Thanks for watching, and I will see you soon. Bye.